Will the upcoming Jackson Hole Symposium Friday be simply a meeting of minds between Fed Chair Janet Yellen and the ECB's Mario Draghi, or can we expect some big surprises? Joining us today is the Street's Scott Gamm. Scott, welcome back. Good to have you back on.
Thanks, Daniela.
So from what I'm hearing, we should be expecting more of the same from Janet Yellen and the Fed, but we could possibly see a big surprise from Mario Draghi. And I know offline you were saying this marks his return to Jackson Hole.
Yes, Mario Draghi hasn't been at Jackson Hole since 2014, and at that time, he really unveiled what became the ECB's quantitative easing program, which started about 6 months later. And since then, look, you have to hand it to Mario Draghi. Inflation is up, unemployment is down, Eurozone growth is up, so he did a good job. I don't think he's going to shock the markets in this speech. I mean, the big question now with the ECB is, do they end their quantitative easing program? It's set to expire in December. And we heard in the minutes from the ECB just a few weeks ago that any decision on this program is going to be made in the fall. So I don't think he's going to use this opportunity to shock the markets.
Okay, so you think we'll still see, the ECB keeping historically low level interest rates here?
Oh, absolutely. They're going to stay within negative territory for the foreseeable future. The only question is what happens to quantitative easing. They're still buying about 60 billion euros of bonds per month. The question is, does that end?
So if we do see a change there, Scott, how can that ripple down to the U.S.? What effect would it have here?
Well, it's interesting because obviously the Federal Reserve is going the other way. They're trying to trim its balance sheet. They're still doing enough QE per month just to maintain that $4.5 trillion size of its balance sheet. But I think the big thing with the Fed, and what I think a lot of investors will expect Janet Yellen to talk about, is inflation, right? Inflation has been weak both on the CPI and the personal consumption expenditure price index. And, obviously we have low oil prices, we have, falling cell phone bills. But I don't know if we should necessarily be surprised that inflation is so low. It's actually kind of the Fed's fault that inflation is so low. Consumer debt is now more right now than it was in 2008 thanks to low interest rates. And consumer debt is deflationary, right? It costs money to service debt. So you can't be surprised that there's no inflation if consumers are in a lot of debt.
But when you say it's the Fed's fault, do you know, was it done intentionally?
Well, I think a lot of people would argue that the Fed kept interest rates too low for too long, and they should have moved back in 2014, 2013, when at least you had some stronger GDP growth. You could argue they had a window to go then, but of course we know the Fed didn't pull the trigger until 2015.
All right, so all this said, what will you be watching Friday? What stocks could be moving?
Well, I think watch the financial sector, right? Because it still remains unclear if the Fed is going to go ahead and raise interest rates one more time this year. We started 2017 with the Fed forecasting 3 hikes for this year. Now, they did 2 of them. The big question is, do they go one more time and meet that forecast? Obviously, if they do, that would be good for the financial sector. We know banks make money from that yield curve play, so higher interest rates would benefit the banks.
All right, Scott Gamm, thank you so much for that Fed preview.
Daniela, thanks.